Nick from Nick's Investment Lab, and today, a little bit about tax loss harvesting. So tell me, did you have an investment that lost money this year? You actually might be able to turn that investment loss into a win. So tax loss harvesting is a strategy where you sell an investment that has gone down in value so that you can actually use that loss against a capital gain. Put it a little bit differently, losses happen, but smart investors use them strategically. Now, tax loss harvesting only matters if you have realized capital gains. Otherwise, you have nothing to use these losses up against. So the good news is that if you don't have any gains, you can actually carry these forward indefinitely. Here's where people mess it up though. The superficial loss rule. If you buy or sell a substantially identical stock or ETF within a 30-day period, your loss can actually be denied. The idea being here that you only sold it for tax purposes. And even if that's true, they don't need to know that. So to keep your deduction, a few things you can do. Number one, don't buy back that same stock or ETF within 30 days. Don't have your spouse or another account repurchase it. Once again, if you do it just in one different non-registered account, it will still be picked up. And lastly, don't sell and buy inside different accounts. Just do it within all the same investment account. Keep it straightforward. No need to muck around with it. Now let's walk through the simplest version of this strategy. You buy $10,000 of a given stock. Let's say it was on January 1st. Let's say that during the year, the stock falls in value down to $7,000. Now you go to sell it on December 15th and the stock is worth $7,000, implying that you have a $3,000 capital loss. Now, to make the tax loss harvesting rule make sense, you then purchase a similarly structured ETF. So to maintain your asset allocation and your portfolio goals. And there you go. You've avoided the superficial loss rule. Now, for those that like to use ETFs, here's a couple of safe pairs that you can use for superficial loss purposes, or for the sake of avoiding superficial losses. Once again, the idea is to stay invested, but to avoid the 30-day blackout and still keep that similar exposure. Now, there are a few times where you might not want to harvest those superficial losses, and when they can actually hurt you. If the loss is tiny and trading fees outweigh the benefits of the actual loss, if selling triggers a big gain elsewhere, if you're planning on rebalancing soon anyways, if you risk breaking that superficial loss rule accidentally, no point doing that then, and if it knocks you away from your long-term strategy. At the end of the day, tax strategies are meant to enhance your financial plan, not to be your financial plan. Now lastly, and this may have not been obvious, is this only applies to non-registered accounts. If you have a tax-free savings account, an RRSP, a first home savings account, an RESP, none of these types of accounts does tax loss harvesting apply. So once again, looking at this over the long term, to be blunt, it will not make you rich. It will not be the factor that makes or breaks your financial plan. But it can help with your tax bill and overall can be a net benefit to your investment planning. Overall, losses happen. Smart investors use them accordingly. For all inquiries, please reach out to nicksinvestmentlab@gmail.com. Please like, comment, and subscribe, and please follow us for future videos. Thank you so much, and talk to you again soon.